Hello and welcome back, everyone. I hope everyone enjoyed that break that we just had. We are going to go ahead and get started on our standalone presentation of the day, which is another great title, which is Winter is Coming, Signs of Stress in Real Estate and How to Capitalize. Our presenter today is our good friend, Bill Bymel, who is the Managing Director of Spurs Capital LLC and First Lane Capital LP. A little background on Bill. He's a professional with 18 years of experience in real estate. Bill has been known as a pioneer in the distressed residential mortgage investment space by creating a new paradigm for dealing with delinquent borrowers. Both his strategies and experiences, personally overseeing the resolution of hundreds of millions of NPL since 2009, are illustrated in Bill's book, Win-Win Revolution, an insider's guide to investing in the secondary mortgage market. But here, the leader of that revolution is Mr. Bill Bymel. Take it away whenever you're ready, sir.
Oh, thank you so much, Merrick. And thank you all for attending here today. We have only a brief period of time, and I have the honor of sharing some data and information for you about where real estate is headed, both commercially and residentially, in the coming months and years. So I know it's a lunch break for many of you. Thank you for attending. Hopefully you will not puke up your lunch with some of the stuff that we are here discussing today. You'll notice the title of my talk here is Winter is Coming. For those of you Game of Thrones fans, it is a reference to that. Over the next 20 minutes, we are going to start with looking at what happened at the beginning of the pandemic in terms of financial and secondary markets. We'll talk about government's intervention that started in the spring and has carried through to today. We'll look at that effect on retail, small businesses, and commercial real estate. I'll give you a little brief glimpse into some of the data that we're seeing on the residential mortgage and foreclosure world. And then we'll talk about the opportunities that lie ahead. If you have any questions, please feel free to ask them now or at any time during this presentation. They will be communicated to me at the end. If we have a little bit of time, I'd be glad to go through my question and answer period. And of course, if we don't get to it, then you can email me outside of today's conference or text me, and I'd be glad to answer any questions or provide any information. As discussed, my name is Bill Bymel. I've got 18 years of real estate and mortgage finance experience. I started as a fix and flip investor in the early 2000s. Ran several successful brokerages. I'm a partner in a commercial retail advisory firm. We represent clients like Darden restaurants, Family Dollar stores, Whole Foods, just to name a few, McDonald's, BJ's Restaurant and Brew House, and we handle all of their expansion in the South Florida area. I've been involved with that firm for about 15 years. I became an investor in the non-performing mortgage loan space in 2009, just following the last financial crisis. And what was important to me about this was that we were buying debt. And the paradigm by which we operate was key, because none of us want to be debt collectors. But I saw an opportunity in buying non-performing loans at a discount to their face value, both on the commercial and residential side. And I actually wrote a whole new paradigm about how we manage these investments. It's in my book called Win-Win Revolution. There is a link here for you to fill out a form. I'd be glad to send you a free copy, or you can pick up a copy on Amazon for $11.88. Let's talk about March of 2020, where things stood back then. As you may recall, the world's markets kind of froze. There was what many in the industry call a liquidity freeze. It came as a result of plunging equities markets, instabilities in the bond market, and other secondary markets where money was stopped flowing. When you talk about the secondary market, whether it's in mortgages, bonds, or anything, you really have to think of the secondary mortgage market as the pipeline of money that fuels our economy. So if you go to the gas station one day and all of a sudden that gas won't pump out of the pump, it obviously can cause some disruption in your life. And the same is true with financial markets. We saw some liquidity concerns as early as November of 2019. You'll see this Reuters article that I'm circling here. There was already some liquidity concerns coming into 2020. And obviously, when the uncertainty of COVID came along, the markets got frigid. So they call it a liquidity freeze. I love to show this image because it reminds me, I always picture this picture when I think of liquidity freeze. Money is not actually freezing, needless to say, but the availability of money to people that utilize leverage either to purchase real estate or fund mortgages in the real estate world, that's a very important spigot to keep open. And so when those spigots close down, all of a sudden we saw a huge amount of distress in mortgage finance. I was being given tapes that were being offered to me by mortgage investors, loans in the commercial arena that would normally sell at par or 102 all day long. In April, I had an opportunity to pay 80 or 90 cents on the dollar for performing loans. The non-performing stuff, we backed our bids up several points and we were able to acquire about 35 million of non-performing in the residential space this summer. But the Fed, what happened when this liquidity freeze came and why wasn't it worse and why did things all of a sudden turn around in the spring is very simply that the Federal Reserve, that Congress gave the Federal Reserve and the US Treasury a blank check to come in and flood the market with new printed money. They've done this in the way of buying mortgage-backed securities and government bonds. So this is one of the two types of government intervention that has played a crucial role in turning things around this spring, kicking the can down the road. That's why we've seen the market recover the way it has and asset inflation the way we've seen it here. There, as mentioned, two types of government intervention that have taken place since COVID. And it's important to understand what they mean for you as an investor and what they mean for us as borrowers and what they mean for the industry as a whole going forward. The liquidity support to credit facilities and loan originators and investors, that got backstopped by the purchasing of the government mortgage-backed securities and government bonds. The second government intervention that has taken place here this year are the moratoriums on eviction and foreclosure. If you own a piece of real estate that is backed, has a leverage on it, a mortgage on it, that is backed by the federal government. The government has said you cannot evict tenants out of that property. If you go bad on a mortgage, whether it's residential or commercial, the mortgage holder cannot file a default. They cannot start foreclosure actions against you. And then that applies to about the 30 or 40% of mortgages that are government insured in this industry, in this world. And even within the private sector, many private lenders have followed suit, as we'll get to in the data in a minute. But those private lenders who have followed suit as well are kind of taking the government's lead. Now, what has changed on a state-by-state basis and on the federal level, the government said if you have a pre-COVID default, then anything that was stopped because of the COVID moratoriums, but was not a default due to the COVID pandemic, then those cases have reopened in most states around the country. You'll still find local judges in various states uh, who will stand in the way of moving cases forward during this time, and there is some uncertainty as far as what the markets will look like come January if we open up the floodgates and end all moratoriums. Hence, you see articles like the one that's here, America's looming eviction crisis threatening tens of millions of people. When you get into that article, you realize that it's not just the residential real estate market, but it certainly is just as much the commercial real estate market. You must understand that small businesses are going to play a large role in that decline. And it's a result of obviously a retail apocalypse. We have seen the writing on the wall with regard to retail for a few years now, believe it or not. We've already seen the slow death of malls around the country since Amazon has really grown in its market share in terms of consumer product distribution. Brand and obviously COVID came along and just put the nail in the coffin for a lot of these large retailers. Century 21, Neiman Marcus, Lord and Taylor, names that have been around forever, Sears, Macy's, all these guys are gone, and they probably will not come back, or most of them will not come back. And you'll see this article from a few weeks ago that economists on average, 2/3 of economists do not believe this economy will return to pre-pandemic GDP levels until 2021. The other third are saying third or fourth quarter of next year we'll start to see activity. But the majority of economists in the world believe 2021 will be the year that we could possibly reach the GDP numbers that we're at right now. It's important to get data where we can. So we look for interesting angles to get this data. And one of the engines that drives the American economy is small business. And there's a lot of services that track it. I was very intrigued by an article that I read on CNBC last month that uses Yelp data. And that Yelp data is showing that 60% of small business closures that were supposed to be temporary are now permanent. And we're up to, as of the 1st of September, between March 1 and September 1, in a 6-month period, 163,000 total businesses have closed down, with almost 100,000 of those being permanent at this point. I'm sure we're beyond that. So the death of small business is really the unspoken damage that really isn't getting the attention that many of us would like to have it get. My guess is that reality will start to set in the coming 60 to 90 days as people really start to see that things are just not bouncing back in the V-shaped way that we hoped. This I pulled this morning off of a webinar that I attended with the Federal Reserve Bank of Atlanta. And this only applies to the leisure and hospitality small businesses, but as many of you know, that's a huge percentage of the small businesses in this country, the service industries that surround leisure and hospitality. And you can just look at the decline in small businesses in the last 6 months. This is data as of last month. And it was given to me directly by someone at the Federal Reserve Bank of Atlanta. The numbers are obviously very, very scary. So what have commercial landlords done? I think it's an important thing to understand that the effects on commercial landlords and commercial real estate investors is not going to just be to the small businesses. It's large corporate commercial real estate investors that are suffering a lot of the same fates that small businesses are suffering. And one of the other unspoken tragedies of this pandemic is the number of retail malls that have been handed back to either special servicers or lenders just in the last 6 months. Just in the, and from very experienced investment managers who made a lot of money managing and investing in these malls, and then when things have gone bad over the last year, have simply just walked away. Companies like Starwood that has turned over, at last count, I think they've turned over the keys on close to 15 retail malls around America. And why did they do that? Because they went out and got CMBS loans, mortgage-backed security, non-recourse loans, and they got them based on huge valuations from 5 or 10 years ago in the retail sector. And now those malls, because of the drop in rent revenue and the increase in costs, those malls are now worth half of what the debt is that encumbers them. And look, the Starwoods, Brookfield Capitals, and Namdar Realties of the world did not get too badly hurt. They all made a lot of money pulling cash out of these properties through CMBS financing and returning a lot to their individual investors. It looks like the mortgage bond holders are going to be left holding the bag here. And that's unfortunate. Well, I want to focus on the mortgage market specifically because that's my specialty. That's what we do. We've placed close to $1 billion in equity investments in primarily the residential mortgage market over the last decade, primarily non-performing, but some sub-performing and some performing mortgages as well. It's important to understand how massive this market is and how a significant amount of investment dollars can only be a fraction of market share in this industry. At any given time, there's a $12 trillion US residential market and a $3 trillion commercial market. That's the amount of debt that is encumbering real estate in the US. Obviously, the residential market being much bigger. A standard default rate, which we've seen, let's say pre-pandemic, in February, if we were looking at February of this year, we had about a 3% of the residential mortgages in this world that were in default. That represents over 300 billion with a B of mortgage debt that's in default at any given time. It's important to understand those numbers in real numbers because a 1% move in the mortgage default rate across the board, when you include commercial and residential, means $150 billion of new non-performing debt that the banks have to deal with and the special servicers have to deal with. So slight moves that you'll read about in the news, oh, we had a 1% increase in the default rate. That's a lot of loans that have gone bad. And so for us as a company, we're deploying, let's say, $100 or $200 million into that market as NPL investors. There's plenty of addressable inventory for us to go after. Here's where residential stood last month. It's important to understand that with the government intervention in place, the mortgage market has been kicking the can down the road significantly these last 6 months. There are close to 3 million loans in forbearance currently. That's another $600 billion worth of unpaid principal balance that's sitting on the books of either government insured loans or private industry that is not getting paid, is now a non-performing forbearance loan. We met with these stats come from Black Knight. Black Knight is one of the largest residential MSP servicing data providers in the United States. They are the largest, and they handle a lot of the data for our loan servicers here. Um, and one of the things that we learned about a few weeks ago when we met with their chief economist was the fact that in the coming 60 days, almost 2 million of these 3 million loans in forbearance are now due to expire. You may have read 2 weeks ago that we saw the largest decrease in forbearance loans. 650,000 loans ended forbearance. And that sounded great when you read it, but when you dig deeper, what you realize is that the loans exiting forbearance, there's no guarantee those borrowers will start paying again. And actually, we're seeing about a 10 to 15% default rate. So out of those 650 that came off forbearance, we can expect 100,000 loans to go bad in the coming 60 days there. And there's another 1.5 million loans that were supposed to come off forbearance that didn't come off. So there is a lot of kicking the can down the road by way of government intervention. And the question really becomes, what's going to happen to all this non-performing debt? Come January 1, the banks are, even when the courts reopen in judicial states, you're going to have a flood of inventory. You're going to have evictions and foreclosure moratoriums that have built up. Even the standard 2 or 3% of loans that would have gone into default last year, there was no legal actions that started. When you compound that, a year of regular defaults, and compound that with the additional hundreds of thousands of residential loans that are going bad, or we don't know what's a commercial could be much worse. That could open up opportunities for individual investors. And that's where we come in. If you're an investor in real estate where there is going to be a huge NPL opportunity in the coming 18 months, it's starting this quarter. See, banks and investors in mortgage debt, they value that debt based upon its performance. So while you and I know that if I buy the first lien mortgage on a retail strip center or on a house, that I'm in first position and that there's underlying asset value that I can always protect my investment with. To a bank, that loan, that paper, the value of that disappears overnight when there's no performance. So when a bank has to market the value of a loan that goes non-performing or sub-performing, it really has no value. And banks have to increase interest reserves. They have to send it to special servicers. Servicers get overwhelmed. You and I know that the actual underlying collateral has value. And what will happen this go around will be similar to what happened the last time. There's a huge influx of non-performing loans. The mortgage loan servicers are not equipped to handle the volume. Banks and investors, if they're leveraged, they're going to be pressured by their leverage facilities to move this bad debt off their books. And if they're not, if they own these loans and they're bad anyways, they're better off in many cases moving this inventory off their books rather than have it sit on their books at a zero value. So that's really where we come in. We act as a liquidity provider to whole loan borrowers. We've been doing this for over a decade. We really see our value that we provide to Wall Street as being equity players that can come in and buy these loans at a percentage of the underlying collateral value. And then we see our job as being a Robin Hood to individual borrowers. I really key in on that term because my whole paradigm is about talking to borrowers and asking them how they would like to see these deals resolved. And at the end of the day, when you treat a borrower with dignity or you offer them an option to come up with resolutions, then you can come up with win-win strategies to resolve. So we've been very successful in that. We see an opportunity on the horizon. We've already acquired a lot since the pandemic, and we're very excited by the opportunity that lies ahead. So within this realm of opportunity, I hope that this information has been enlightening. Certainly, there are some tougher days ahead, no doubt. But as an investor in the non-performing loan space, I am obviously very excited about the opportunity that lies ahead. We see it as not only an opportunity to make a ton of money for ourselves and our investment partners, but we also see it as an opportunity to bail America out of the looming crisis, one mortgage foreclosure, one loan at a time. If you have any questions about my strategy, please feel free to email me. I think we kind of ran through to the full 20 minutes and a little over. So, Merrick, I don't think we have much time to take questions unless you think we do. And other than that, it's been an absolute pleasure. Any questions there, Merrick, or should we just call it a day?
I think we're gonna call it a day. But Bill, thank you so much for being able to join us and show us these stressors in the market. Like Bill said, if you guys have any questions, please feel free to take down his contact information. Follow up with him directly, and also follow up with him to get a copy of that book, The Win-Win Revolution. I also just want to give a shout out. Bill's also going to be doing a webinar with us. We have one coming up on December 8th, if I'm not mistaken. And
That's
to
right.
the audience, if you'd like to see some of his other webinars that he has done with Opal Group, feel free to go to opalgroup.net and check under our on-demand tab to view some of those about finding safe, opportunistic investments in times of turmoil.
Sounds great.
All right.
Thanks, Merrick. It was good seeing everyone. Good luck. Stay safe. Stay warm.
Stay safe, Bill.